Welcome everyone, my name is Blake and I will be your moderator this evening. I'm excited to welcome Dr. Tom Snyder for an in-depth review of practice value influencers. Before we get started, I'd like to note that CE is not available for this webinar live or on demand. Welcome Dr. Snyder, and I will pass it over to you now.
Good evening. I'm Dr. Tom Snyder, Senior Director of Transition Services for Henry Schein Dental Practice Transitions. Thanks for joining me this evening. We have a lot to talk about. It's going to be one of my favorite topics, practice valuations, and give you an update on where we see values today. I've been valuing practices for 30 plus years, so I've seen a lot of cycles, valued lots of practices. Our company values about 500 practices a year, so we're pretty familiar with the marketplace and the different methods. So let's get started. Our objectives today, we're going to discuss briefly the valuation trends around the country. We're going to review with you common valuation methods. We'll discuss the top factors affecting a dental practice's value. And we'll discuss briefly steps to increase your practice value. And a very important topic, developing an emergency exit strategy. And finally, strategies on valuing practice record lists. So there's lots of reasons why you need to value your practice. It's not just to sell your practice, obviously, but there's others as well. For example, many of you might have an associate, and you might be thinking about having that associate become your partner. So you'll need to have a value established for that buy-in. Also, if that same person is going to buy you out, you need to have a way to make sure the second half of your practice is valued. We're going to discuss emergency exit strategy later this evening. Estate and financial planning. If you're considering the proceeds from the sale of your practice to be an important component of your overall plan, it's not a bad idea to have a value done to assist in your financial plan. Some of you may be considering merging your practices, so we need to know what the values of both of those businesses are. Unfortunately, it might be a matrimonial or a partnership divorce, and there are reasons to value your practice for those purposes. Also, if you're in a family situation and you're considering gifting and or you have a C corporation, there is a need to have a personal goodwill valuation done. And finally, on a very limited basis, since most C Corps have been converted, there still may be a few out there who are considering a conversion to an S Corp, and you need a valuation for that purpose as well. So as you can see, there's lots of reasons why you need to place a value on your practice. So in kind of teeing it up for our conversation tonight, I think we need to look at our dental landscape because as we all know, lots of things have been happening. Clearly, the big event the last few years was the pandemic, and that, of course, made a big impact on our economy, on our practices, our personal lives. And one of the things that we found is that the practice modalities are shifting. In 2015, 50.3% of dentists were in solo practice. When I graduated from dental school, I would say about 90% of dentists were solo practitioners. In 2021, that number decreased to 46.2%. So because of the pandemic, a number of older doctors decided to close their practice or merge their practice in because they no longer wanted to practice. So we saw a good number of solo practitioners leaving our profession. Also, statistics from the American Dental Association have shown that only 1 in 5 dentists under the age of 35 want to be a solo practitioner. Now, why does that have an impact on values? Well, if you're a solo practitioner and you want to sell your practice, you're going to have a less liquid market, so to speak, where only 1 in 5 dentists under the age of 35 want to purchase a practice as a solo practice. So that could have an impact on your value. Another trend that seems to be continuing, and I don't think it's going to abate, is that overall practice ownership has declined from 84.7% in 2005 down to 73% in 2021. That's a significant drop. And we find on a gender basis that female dentist ownership was at 68.1% in 2005. Now it's just about 60%. Male ownership in 2005 was 88.5. Now it's at 80.3% in 2021. So there is no question that our younger doctors today aren't necessarily going to be business owners as many of their predecessors have preceded them on. So that's a big thing that could have an impact because there's less potential people out there who want to own. So that means less potential buyers that could have an impact on value in the future. We also see that the average retirement age has declined over the last few years. Now it's hovering at about 67.9%. We also see a significant increase in doctor retirements, and this I think was directly related to the pandemic. There was a 22% increase in the number of dentists age 55 or older who retired compared to a prior 4-year average. So it stands to reason that older doctors, are finishing off their career, and so we're seeing an accelerated amount of retirement. That wasn't the case years prior, where we always had a situation where we had more dental graduates than doctors retiring. We're getting close to that break-even point where at some point in the not too distant future, we will have more doctors retiring or selling than graduating from dental school. And that will have a profound impact on values because that all relates to supply and demand. Average educational debt in 2022 was $286,000. 19% of that class had no debt. So that obviously is having a direct impact on why some dentists don't want to be business owners because they have such debt they feel they'll never be able to recover. We also find that it's been a seller's market for some time, and it may be for the foreseeable future, especially in the private sales space. That means doctor to doctor, not in the corporate DSO mode, which we're going to reference in a second. Now, if we look at this graph, these data points are about 2 years old, and we'll see we have about 30,000 doctors still in active practice who are 65 or older. So if you begin to look at that group, you can readily see why the number of retirees is increasing. So more practices will come on the market. And I would suffice to say that of that 65 plus group, most of those doctors are solo practitioners because historically was the predominant practice mode. So that will have an impact on the number of doctors retiring and in some cases on practice values. Now, we all know about the dental consolidation that's been going on for the last 15 years, and it continues to accelerate. We have more than 350 dental support organizations out there of varying shapes and sizes. And in the data is most current as available, that's in 2019, 10.4% of all US dentists were affiliated with DSOs. And obviously 4 years later, suffice it to say that number is going to be significantly higher. We don't know what it is yet, but that will be reported, I'm sure, in the not too distant future. However, when we look at that group of dentists who are affiliated with DSOs, we see that about 20.4% were under the age of 34. Again, high educational debt, less doctors interested in owning. You can begin to see the trends developing. And 13.9% were between the ages of 35 to 49. As a matter of fact, DSOs now are focusing on younger practitioners because they would rather have a doctor with them for an extended period of time than purchase a practice of an older doctor where they may only be with them for several years. Then they have to go out and recruit replacements. So we're seeing a trend there as well. Now, obviously, rising interest rates are continuing. Who knows where we're going to be at the end of 2023? Hopefully, we'll start to see an abatement, but we don't know. However, we do know, because we're involved in practice sales as well as valuations, that we're seeing some shift in values with DSOs. Obviously, there's a cost of capital that they are sensitive to. So we're beginning to see some structural changes in deals right now. We're seeing some multiples of EBITDA, which we'll discuss a little later, that are beginning to be a little bit lower. And with some DSOs, they're kind of going silent right now. And those that we work with are saying maybe we'll start getting active in Q3 or Q4 of this year based on interest rates. And you can imagine with higher interest, higher cost of everything, profit margins are being squeezed, not only in a private practice mode, but obviously in the DSO world. So, you know, they're working hard to keep their margins up there. One of the contributors is staff recruitment, not just for hygienists and for dental assistants, but in certain instances, in some markets, for associate doctors. And that's a real challenge. And so consequently, cost of labor will continue to go up and things of that nature. So that's going to be a challenge in managing either a private practice or a DSO. Now, as I said before, interest rates have been going up, but our dental lenders are still loaning money. Yes, interest rates have crept up, but nowhere near the double-digit interest rates of many years ago. So right now you might see between 5 and 6%, some cases maybe a little higher, but bank financing with the dental lenders is extremely competitive and very strong. So if you're a young doctor thinking of buying a practice, you certainly can find dollars out there to loan. So now let's get to the meat of the matter. What is a dental practice worth, and how is the value determined? This is a broad brush statement. The majority of dental practices, including specialty practices, will vary between 60 to 85% of last year's gross receipts. Now, this information that I'm sharing with you is what I call private sale, doctor-to-doctor transactions, not owner to DSO transactions, where the values are considerably higher, as we'll chat when we discuss EBITDA. So we're finding that the specialty market is extremely strong. Ortho and pedo are definitely the higher valued practices, and the lower valued practices are prosthodontics and perio. And part of the reason for prosthodontics and perio is because of the number of specialists out there. Again, this is just a range, because as some of you know, and you've read, maybe you've taken other programs on practice values, that 60 to 85% is a wide range, I admit. However, that range is dictated primarily about where is the practice located. For example, if you're in Northwest Maine, your practice's value will nowhere compare to what a practice in New York City may be valued at. Why? There's less dentists in Maine who practice. There's less buyers in Maine. So consequently, you have this supply and demand situation. So practice values in Maine are considerably lower than in New York. But you could look at almost any state in the union, and based on where that state is and the number of dentists in that state, you have wide variances in value. Now, suffice it to say that in the major metropolitan areas throughout the United States, values are higher. Why? because that's where doctors prefer to practice. Recent grads are not interested in going to rural areas or small town markets. They want to be where the action is. So consequently, you've got more buyers there. So when a doctor wants to sell their practice, especially on the private sales side, there's a lot of potential buyers out there. And consequently, as long as the practice being sold is a strong, good practice, then chances are there's more than one buyer, and consequently, those doctors will get a nice value for their practice. Now, when we discuss practice values, we have two terms which we're going to briefly hit on. First is market value. Market value is the price at which a practice will sell when it's offered for sale by a willing seller and purchased by a willing buyer, both being informed of the relevant facts and not being under duress. In other words, they're not compelled to buy or sell. It's a market transaction. However, when we value a practice, we value it based on the transaction value, which is the price at which the practice's assets are likely to be valued at as a going concern in a particular geographic area. At the end of the day, the number is the number. It's just how we get there and what methods we use to value it. Now, when we value a dental practice, it consists of two asset classes: intangible assets and tangible assets. And we have found over time, by the number of practices that we sell and the allocations that we get involved with in the sale process, that typically the intangible assets, which is usually mostly goodwill, is about 75%. The tangible assets at about 25%. Now, that's not a hard and fast rule. That is a guideline. If your practice has newer equipment, conceivably, that ratio could be 70-30 or maybe 65-35, 35, of course, being the tangible. Again, it just gives you an idea of how a practice's value is broken down to. Now, if we look at our tangible assets, they're pretty easy to understand. It's the dental and business equipment. It's the technology, instruments and supplies, and leasehold improvements, if in fact the building or the building is not owned and you're a tenant. Oftentimes we'll include the leaseholds in our valuation. If the property is owned by the doctor, chances are there's a separate entity and those leasehold improvements are contained in the separate building entity. Intangible assets, as I said before, predominantly is goodwill, a slight allocation to restrictive covenant, a small allocation to patient list, and in some instances, particularly multiple locations and or specialty practices, the phone number can have a very, very decent value. However, in the dental world, in the valuation space, typically accounts receivable, cash, and liabilities are not included as a part of the practice's value. So if we were to say your practice is worth $800,000, your receivables could be 100. You may have some liabilities as well as some cash. We don't look at those other items. We just basically say on the valuation methods that I'm going to review in a minute that we do not include those items or liabilities. They have to be accounted for in the transaction. Now let's look at some of the common valuation approaches. We use 3 valuation approaches, and each approach can use multiple methods. The first one we're going to discuss is the market approach. And the market approach is simply what it is. It's a market approach. We look at what practices have sold for in various parts of the country. We subscribe to several databases, Goodwill Registry and Pratt's Stats, now called Deal Stats. Additionally, we have thousands of practices that we've sold in our own database, so we kind of know what deals are being sold for around the country. So between those 3, we come up with what we think is a value relative to what? Relative to the region, relative to the state, as well as nationwide. So we try to drill down to give you a more realistic look at a value. And that's really based on the data that we use in this approach. So this does not look at anything other than the gross receipts and the overall profitability. We come up with a range of value with the guideline transaction. Now, I want to digress for a second to mention one thing that some folks who sell practices value on, and that's called a gross revenue multiplier. And the gross revenue multiplier is simply what it is. Let's assume that we use a 70% multiplier. So practice A has gross receipts of $400,000. We use a multiplier of 70%. So in this case, practice A would be worth $280,000. Now we'll have practice B. Those gross receipts are $600,000, and the multiplier is 70%. So that value is $420,000. Practice A has overhead of $200,000. So 200 from 4 is $200,000 net income. Practice B, which in this case has a lot more insurance, has a higher overhead ratio of almost 67%. So the overhead's pretty high. What's the net income? $200,000. So we have two practices with the same net, but different gross receipts. So one of the problems in this approach, it really doesn't take into account the net income, because at the end of the day, yes, when you buy a dental practice, you're buying a facility with a location, with patients, with doctor goodwill, but you're also buying the historical cash flow of that business. So the more profitable a practice is, the more money you're going to make, and you'll easily be able to afford an acquisition loan. So that's what you have to kind of look at when you're looking at a practice. It's what is its real cash flow? And that gets us to the second approach, which is the income approach. Now, this is a little bit more involved and a lot more technical. There are various methods that are used. And what we're trying to do here is evaluate the cash flow of the practice. In our approach to valuations, we look at the 4 years of financials. So right now, since we're only in April, we'd be looking at 2022, 21, 20, and 19. And I can say with certainty that although we look at your 2020 return, it's not going to have a substantial impact on value, because what we're going to look at is how well did the practice rebound in 2021 from 2020, as well as continuing on in 2022. So we obviously collect tax returns because that's the only way we can verify income, meaning you give us a signed tax return, we assume you submitted it to the Internal Revenue Service, so that's a documentable item. And that's what banks need to look at too, right? They need to look at tax returns. Now, if you're a sole proprietor, chances are you don't have a profit and loss statement that's prepared by your CPA, although most doctors now have software that they can generate profit and loss statements. So we'll also look at a profit and loss statement, because sometimes that gives us a little further explanation about certain expenses that are listed on a tax return. Most valuators will normalize certain operating expenses. And so they have to be consistent with national norms as well as practice historical performance. And the major categories that are normalized are dental supplies, office expenses, rent, professional fees, building repairs and maintenance. Obviously, if someone presents with a 15% dental supply ratio and that practice is sold, I don't think the buyer wants to continue a high ratio of dental supplies at 15%, where arguably it could be reduced 8 to 10 based on the service mix of the practice. So what do? We normalize that expense as the same thing with office expense, because oftentimes doctors will put a lot of personal expenses and office expenses. Rent obviously has to be normalized, because what if a doctor is not charging a rent? We have to impute it. Or if the rent is really over market, it should be at market, so we normalize that as well. In the income approach, what we're trying to determine is the practice's true earning stream. Discretionary expenses are then added back to that. For example, dues and subscriptions, continuing education. If a doctor is running a car or truck through the practice, that's added back, okay? Certain insurances and owner's pension contributions, not staff's pension contributions. Why? Because based on the age and the type of pension plan, that owner may have a significant contribution, which a new owner may not wish to continue. So that's why it's added back. And in cases where there may be family member or members hired for tax purposes or financial planning purposes like pension contribution, we have to factor that into the equation as well. So what we're trying to do is come up with a net income plus discretionary expenses, and we normalize those, make the normalizing adjustments, and we come up for the benefit stream for the doctor. Now, this is actually an excerpt from one of our exhibits in our practice valuation, which, by the way, is a 30-page document, very detailed report, and it shows the way we make adjustments to the income and expenses. And you'll see doctor salaries. We normalize doctor's salaries because a doctor, unlike someone in a corporation, they can pay themselves anything. So for comparative purposes, we use percentages of production. If we know if it's a general practice, we know what the hygiene department's doing, we'll take that away and multiply it by a certain ratio that's an industry ratio to come up with the doctor's salary that we think is true and estimable. Now, the method that we use in the income approach is the capitalized cash flow or capitalization of earnings method. And basically, we're going to come up with a value based on the present value of future economic benefits. We bring back what we think that value is on an earnings stream. And so that gives us a number. And in that number, though, we're looking at risk factors. You know, is it a specialty? What type of specialty is it? Referral base? How many treatment rooms? What's the payer mix like? Is it fee-for-service, Medicaid, Medicare, of course, PPO? How about financial market returns? We look at certain ratios to come up with the cap rate. And what you need to understand is when we use a cap rate, the higher the cap rate, the lower the value, because a higher cap rate means there's more risk in that transaction. So consequently, you'll pay less for that practice than a practice that has a lower cap rate, where there's good overhead control, lots of positives. So you're willing to spend more or you'll get a higher value. And that's basically how that method works. The third approach is the asset approach. It was a relatively simple one to understand. Basically, we identify the assets, we restate them to market value. We utilize the tax returns and the asset detail report that most accountants will file with the return. And we use our internal formula to come up with what we consider market value, not book value, market value, what this is worth on the market today. So we come up with a number on equipment and technology, and we use internal ratios to come up with an estimate of supplies and inventory. We don't do inventory analysis. We just use formulas. And the intangible assets, really, is the second component of the net asset method. And we use intangible assets. And where do we get that from? Again, we come up with a goodwill number and use a percentage, and that comes from the goodwill registry. So basically, let's say that we come up with a goodwill value of 300. We may use a ratio of 55, 60, 65%, and multiply that by the 300, and that gives us the intangible assets. Then we add the tangible assets to it, and that gives us a number. In the final analysis, we typically use three methods: the guideline transaction, the cap cash flow, plus the asset method, to come up with what we think your practice is worth. Now let's digress for a minute to talk about something that most of you are familiar with, and many of you have been contacted by dental support organizations, either by mail or by phone. Maybe you've actually negotiated with a few, just considering that as a transition option. But the corporate world values dental practices totally differently than how we do it in the private sale market and how we've done it historically. They come up with what they consider to be an EBITDA valuation. And what is EBITDA? EBITDA is earnings before interest, taxes, depreciation, and amortization. That's the magic number that they will come up with. And based on that EBITDA, they will pay a certain multiple of that EBITDA as the value of your business. So for example, if your EBITDA was $500,000, maybe in the area that you practice, we find that the DSOs are paying between 4 to 6 times EBITDA. So the low end is 4 times 500, that's 2 million. 6 times 5 is 3 million. So you can see there's a wide variation. So that's basically what they do. Now, when we look at EBITDA in the marketplace, we find that solo general practices are valued between 3 to 5 times EBITDA. They can be higher, it could be lower. There's a lot of different things that go into the mix. Obviously, at the end of the day, what that means to you is the value of your business could range between 75 to 125% of last year's gross receipts. Now, in cases where there is going to be a roll-up, where there's multiple practices, 12 or 14 times EBITDA is very common. So it's important to understand, as I mentioned to you earlier, we look at the last 4 years of financial performance. Most DSOs will look at 2 years. And the one that's most important to them are the last 12 months. And they like to do it from the date that they start measuring to the date 12 months prior. It's called trailing 12 months. So it's not necessarily a calendar year. It can be, depending on when they do the EBITDA calculation. But if they start looking at your data in May, they may go from May to the prior April. That's kind of how it works. And of course, if you have tax return, they'll look at the prior year just to see if there's been much of a change. Now, in calculating EBITDA, there's a lot of little things that go on. So again, just like we normalize expenses when we value a practice on a conventional basis, they basically will use their own ratios, which in some cases are lower than the standard private practice market. And most notably, the two big ones are dental supplies and lab. Many of these companies are into high tech, so they have lower lab costs than conventionally. Plus, of course, with these big DSOs particularly, they can really get a very good price on consumable dental supplies. So their norms are a little different. Also, they impute compensation for a doctor, and usually that's a lower percentage than what we use on a private sale basis. At the end of the day, what they're going to look at is, after all expenses are paid after any type of management fee is imputed for them, after they consider what they have to pay doctors to work in that practice. They're looking for an EBITDA, and ideally they'd like to see about 18% EBITDA ratio over gross receipts. That if you have a higher EBITDA ratio, chances are you might get a higher multiple because that's more cash for them. So again, it's a totally different way of looking at things, but suffice it to say, just like in the capitalization of earnings method, right, that the lower the risk that they see in buying a practice, you'll get a higher multiple and higher value. If they see higher risk in the transaction, well, it'll be a lower value. So again, with a lot of the corporate sales going on, that's a very common method. And like I said, some of you may have already had an EBITDA calculation done by a DSO who was considering buying your practice. So let's look at some other things that affect a dental practice's value. Obviously, as I said earlier, area demographics, location, key variable, and that will never change. It's all related to supply, demand, number of dentists in that particular region. Facility is also very important. Number of treatment rooms, particularly, for example, a 2 treatment room practice with no room for expansion is certainly going to have a lower value than a practice with 5 treatment rooms, for example, or 3 treatment rooms with room for expansion for 2 more, things of that nature. Age, condition of equipment, that can be a telltale number, particularly in the private sale arena, because most young doctors today are high-tech oriented. They're used to treating their patients in dental school with the best of technology, and if they are considering buying a practice where there's a lack of or older technology, they may not want to pay the top dollar for that particular practice. And as I mentioned before, expansion for growth is critical. If you have a practice that doesn't have that, you're not going to get a premium value, that's for sure. Overhead relates to cash flow, does it not? Of course it does. So if we have a practice with an operating overhead of 50% versus a practice with operating overhead of 70%, one could argue that the value will be higher for the operating overhead at 50%. Now, what contributes to the higher overhead? And sometimes it's not the doctor's fault. Classically, it's high staff costs. A doctor who has been in practice 20, 25 years, has staff that have been there at least 18, 20 or more years. So they're getting lots of fringe benefits, lots of time off. They're highly paid, and rightly so, because they've been there so long. So there may be a pension plan in the mix too that contributes to that overhead. Another big contributor is high occupancy costs, and we typically see that in the major urban areas. Again, that will have an impact on value. Now, there's some other things that will affect a practice's value. For example, oftentimes we'll value a general practice, and the doctor has developed expertise in sleep medicine, or maybe they're doing lots of ortho, and a particular buyer who wants to buy that practice is not interested in ortho and or sleep medicine. So they may say, well, you know, your practice, according to this valuation, is worth $800,000, including ortho and or sleep medicine, but I prefer not to provide those services. So if I'm going to buy you, I need to know how much ortho and or sleep medicine was done. And consequently, I'm going to lower my offer because I'm not going to provide those services. So you won't get paid for those. Insurance plans, obviously, you know, most practices now are impacted by PPOs and will continue to be that way. There are some states where some of the insurance rates are pretty tough, but that has an impact on value for sure. It could also be a situation where there's a lot of turnover. That may be a problem as well, so that we'll have to determine. There could be non-transferable telephone number and or website that could have an implication for value. And the biggest violator of value, as far as negative value, is associate agreements without restrictive covenants. However, with the recent ruling with the Federal Trade Commission trying to change restrictive covenants, that is an open-ended item. We don't know how it's going to play out, what that may or may not mean on transferability, things of that nature, and that could have an impact on values, although it's premature to comment whether it will or not. We just have to see how the rulings play out. And of course, if you're a tenant and you have a lease that's going to expire in less than a year or two, chances are that'll have a negative impact on value. So there's lots of different things that can impact. So let's say that you decide to get your practice valued for any of the reasons I mentioned earlier. And let's say that, it wasn't really what you were hoping it to be. Maybe you're just interested in knowing what the number is today. And you say to the consultant after the valuation is done, gee, Dr. Snyder, what can I do to increase my practice's value? Well, one of the first things we might look at is a fee analysis. Where are you in the percentile that you have been charging? Now, admittedly, if you're a PPO practice, easier said than done, right? If you're a fee-for-service practice, that can have more of an impact. But nonetheless, even with PPO practices, you should look at your fees to see if they're really in line, because you're really working hard and you're not getting paid properly. So in some cases, you may consider a fee increase, and that certainly could have an impact on your bottom line. This we saw quite a bit with all the closures during COVID, where a number of doctors said, I can't, nor do I want to go back. I'm done. I want to sell my practice. Now, depending on what type of a practice that doctor had, whether it was a small or large practice, there were a number of doctors who were simply selling their records because they wanted to retire. And that is something you still can consider if you're trying to increase your overall value. Maybe you're considering bringing an associate in a year or so, and you want that associate to become your partner. You've got to build that practice up, get a higher value. You may consider a records purchase of a doctor in your area who may be at a point where they're considering retirement. How about looking at the hygiene department? Obviously, what are the ratio of perio-related services to overall hygiene production? There could be some substantial opportunities for growth there. Believe it or not all doctors market their practice. But if you're looking to grow for whatever reason it may be, whether it's improving value or getting ready for a sale, a marketing plan is a smart thing to consider. Today, social media is being as prevalent as it is. Some dentists have some very sophisticated social media campaigns to attract patients. And of course, having a website that's informational, that can be used, making appointments, things of that nature, becoming commonplace more and more. And of course, looking at enhancing value, can any new services be added that you have not been providing before? And you may want to recruit an associate to provide certain services, such as endo, for example, or some limited surgery. How about considering any cosmetic enhancements to your facility? One of the things you could do is ask your staff one day, what do you really think of this place? And you can be as critical as you want to be. Carpet worn, old furniture, needs a facelift, paint, you name it. Cosmetic enhancements are important, because if you're going to sell your practice, you want to have that potential buyer come in and have a positive image of your business. And that also may mean updating and upgrading your dental equipment as well as clinical technology. However, it must be remembered, we've had this oftentimes a real problem with doctors who want to sell, where they buy equipment and technology excuse me, but you don't always get a dollar for dollar increase in your practice value. You certainly will get a bump in value, but if you spend $100,000 on technology, you may not get $100,000 back as far as additional value. You really, if you're going to consider enhancement to technology as well as equipment, your goal is to increase your overall production, which of course can have an impact on your value. However, one note of caution, because we've seen this happen with older doctors who buy a lot of equipment because they want to get it ready for sale or increase value, and they sell it 12 to 24 months after they make the purchase. There could be some potential tax ramifications called depreciation recapture. So we always advise folks, if you're thinking of selling, you're going to buy new equipment in the next 12 to 24 months, and you really want to sell in that time frame, make sure that there's no surprises on the income tax side when you do sell. Obviously, looking at your overhead ratios, very, very important, making sure you're within national comparatives. Take a critical look at your current staffing. Are you overstaffed? That could have an impact on your bottom line as well. As I said before, for those who can increase their fees, for example, a 5% fee increase in a practice with a 40% profit margin can generate an 11% increase in net profit. That's called an immediate raise without doing anything else. And of course, if you are a PPO based practice, look at all your PPOs and root out the ones that are the poorest performing, where there's much or little or no return on investment. Now let's go to a more sobering but important topic, and developing an exit strategy, particularly an emergency exit strategy. Unfortunately, the business that we're in, every year we get phone calls where the business owner has died, illness or accident, or has become disabled and no longer can practice. So those are tough times. And particularly in the case of death, it's really important to develop a strategy as soon as possible. We find that only 30% of practices will sell within 90 days of death. There's always reasons why practices don't sell, but when the owner is no longer there, especially in a solo practice, have staff left? Is the hygiene department still open? What's going on? It's a smaller town. Word gets out. Patients can go to another dentist pretty quickly. We also find that an additional 10% will sell after 90 days. It gets worse and worse. And of course, 60% of practices, if it's been on the market 90 to 120 days. So it stands to reason that we all should have a strategy if, God forbid, something were to happen, especially a solo practitioner. And I tell, when I'm on the phone doing some counseling with doctors, if they're a solo practitioner, I'm going to hit you hard and I'm going to say, what's your practice worth? Do you have an emergency exit strategy? Because if you're by yourself and something happens, you need to have an action plan so that your survivors could get something for your dental practice, and that's really important. And what do we do? Well, we have developed a letter of instruction, and it's basically a document that lists all the key advisors that you have, whether it's an insurance broker, an investment advisor, of course, your CPA, your attorney, could be your dental supply representative. It could be a group of people that need to be contacted if an action plan needs to be initiated sooner rather than later. Of course, we believe that you should start this emergency exit strategy by having your practice valued and coming up with the current value. And if for those of you who work closely with your representative at Henry Schein, you may be able to get to meet one of our transition brokers and have their name in there too, if, God forbid, we need to get an action plan. And we're going to let you get a copy of this when we finish this evening. You'll see where you can order it. So basically, if you don't have an emergency exit strategy, why not? Now, in closing, I mentioned, we have a lot of doctors who are still solo practitioners, a lot of older doctors particularly. And since we know that younger doctors are preferring not to practice in a solo mode, there is a number of doctors who are going to finish their career by not selling their practice as a going concern. By that, I mean all the practice at the location with its equipment in place versus selling a patient list to another doctor in the area. That's what we're going to talk about right now. There are two common ways for this to occur. The first is what we call a production or revenue acquisition valuation method. And what we do here is we pay the selling doctor a fixed percentage of receipts for a particular period of time. So for any patient who visits the new location where these patients are now going to, they would receive, or the selling doctor would receive 25% of whatever is collected on those patients for up to 2 or 3 years. Obviously, if it's for 3 years, the percentage paid out is typically lower than if it's for 2 years. And we're going to give you an example in a second. In a revenue or production acquisition method, we always request an initial down payment, and we try to value the patient list at about 75% of the average weighted revenue. We look at the last couple of years of receipts, and we'll take a weighted average, and we try to get 75%. Now, you're sitting there thinking, if you're a potential buyer of patient records, well, that's an outlandish percentage. Who would pay that when we don't know the patients are coming in? And that's exactly why we pay 75%, because we do know that when you do a records acquisition, you, the selling doctor, aren't getting a lot of money up front. You're getting a small down payment. And then you're assuming all the risk, meaning that you're hoping that the patients will go to the new location. And if they do, that doctor should do very well financially. So that's why we use a higher number. And the best news would be that you received your full payout, which meant that that buying doctor got all your patients and probably is doing better financially than he or she ever thought they would had they not made that acquisition. In this method, we make our payments usually on a quarterly basis. And of course, if that in fact is the case, we do try to negotiate that the seller has an option for an annual audit. If they think things, aren't really working out right, they can examine the books. Now, here's how the numbers work. Let's assume that the weighted revenue for this practice was $300,000. So we use a fair market value ratio of 75%. So the sale price would be $225,000. And let's say we're going to pay it out over 3 years, and it's going to be at 20%. So we're looking for a down payment in cash of $25,000. Let's assume that in year one, the practice's receipts were $360,000. And so at 20%, the payout would be $72,000. However, you notice that we only paid $47,000 in year one because we have to pay off the down payment. So we pay the down payment off, then the 20% goes thereafter for the first year. In year two, the practice grossed $400,000 from the patients. And that meant the payment that particular year was $80,000. And finally, in year three, the receipts were $430,000, but we stopped at around $73,000 because that means that we reached our $225,000 sale price. So it doesn't go on forever. So when that amount is met, that's when the counting stops. Now, conversely, if these numbers were a lot worse, let's say the practice did 280, 300, and 320, well, if you did the math, it wouldn't add up to 225, meaning that that doctor would receive considerably less. So in fairness to the buying doctor, they're not paying out all that money because the patients didn't show up. So that's why we try to get to 75%. And usually it works if the doctor has done a nice job transferring patients with a letter and endorsement to the new doctor or practice. Another way of looking at it, a little simpler, is to take the average last 3 years revenue collections, and then we're going to divide that through by 3 to come up with a number of patients, and we're going to pay a per record fee for that situation. And in an individual record purchase, typically is done over an 18 to 24 month period, and that record fee is paid out after the second visit. So we've covered a lot of ground this evening, and I hope that you have a better appreciation of what values are, how they're impacted, how they are different around the country. And if you do have any questions, my colleague Krista Butler will be happy to take your email, and it will either come to me or one of my valuation team based on the questions that you have, or if it's more of a local type of a question that one of our transition sales consultants can answer, they'll be in touch with you directly. So feel free to ask us questions, because I'm sure there are going to be some. Now, I mentioned before our letter of instruction, and you can see in the screen, you'll be able to go to our website and order that and download it. It's a downloadable PDF, so you can fill it out, print it, and give it to your advisors and your spouse, and that way you'll be covered. And of course, we're hoping that you will do a practice valuation. So to kind of encourage you to do it, we're offering a 10% off practice valuation if you make a commitment by July 1st, 2023. So you don't have to do it tonight or tomorrow or next week. In fact, some of you are going to be viewing this at a later date. So you've got till July 1, and we will honor that reduction in our price. So finally, I want to thank you all for spending this time with me. It's something that I've been doing my whole career, and I hope that you found this webinar to be of value to you, and wish you all much success. Thank you and good evening.